Please welcome Brian Green, NAR Vice President, Policy Advocacy.
Good morning, everyone. I'm talking to you live from Washington, D.C., where today it is cloudy. Well, sun is not good for you. I believe it was Woody Allen who said that in Annie Hall, that everything our parents told us was good is bad. Sun, milk, red meat, college. And of course, college was the punchline there. But when you think about college today, college for many Americans means incurring lots of student loan debt. And by that measure, grad school is especially bad for you. So we want to talk about that today. The role of student loan debt today in America and the impact that it's having, especially on millennials in our country. Let's say just back in my day, it was not the same. That what young people are paying today in just a matter of months, I paid in over 10 years. And we hear about this all the time now in newspapers, newspapers who breathlessly talk about how today's millennials are drowning in student loan debt, swimming in student loan debt. We've heard wallowing in debt. For those who've made it to land, they are burdened by student loan debt. What's certainly the case is student loan debt is limiting opportunities for people today. People are delaying the start of families because of it. They're finding it difficult to accumulate savings. And of course, we note at the National Association of Realtors, it makes it difficult for them to buy a home. And we know that home ownership can be the ticket to wealth for many Americans. It helps create financial security for Americans, and it helps you attain equity that allows you to send your kids to college and pass on intergenerational wealth. So this is a huge load, the student loan debt, for millennials today. And many are concerned that to address it might involve taking the load off students and putting the load right on taxpayers or leaving the banks high and dry. But we have to talk about student loan debt cancellation. That's part of the debate. We also have to talk about other options. People are talking about, how private employers can possibly help with student loan debt. Still others say there are front-end solutions, that we need to disrupt the process that is creating unprecedented levels of student loan debt in America today. Are there reforms possible there? What we all agree is that this is the elephant in the room. So I guess what I'm saying is we're going to beam this elephant into your room today and allow all of you an opportunity to get a 360 look at the elephant and study it up close, see what we can do. This is another forum that NAR is hosting to call attention really to the pressing issues of the day. The last forum we had was on housing supply and just the potential crisis this is creating for affordability in America. And coupled now with student loan debt, many Americans are going to struggle even more. And let me just add that this is having a disproportionate effect on people of color. People of color are twice as likely to have student loan debt and to have a lot more of it. So if we want to close homeownership gaps, if we want to grow the housing market and thereby grow the economy and meet the future, we must tackle this. So we're going to start off with my colleague, Jessica Lautz, our Vice President of Research, who's going to give you an overview of the issue and how student loan debt looks today. And then we're going to get into a discussion about possible solutions. Jessica?
Wonderful. Thank you so much, Brian, for that introduction. I'm excited to share research that we actually have been looking at all the way back since 2013 at NAR. And we first started researching this issue because what we heard from members is that their children couldn't enter homeownership, and they were encountering first-time home buyers and working with clients who were really having a hard time entering homeownership due to their student loan debt. Their earnings were there, but they just were not able to enter. So what we wanted to do, and what we have seen over this time period, is that the first-time homebuyer share has continued to drop. It's now at a 33-year low when we look at the annual figures. The last time it was this low was back in the 1980s when we had double-digit interest rates. And so we knew that something else was up here. It wasn't just the interest rates, and it certainly wasn't affordability back when we were looking in 2013 at this issue. There was something else going on. When we look at the data, what we can see is the homeownership rate overall for all age groups when they're looking under the age of 35 by generation. So if we think back to when the older boomers who were out there were under the age of 35, what was their homeownership rate? And we can see it's considerably higher than what the millennials are facing today. The last time actually that the homeownership rate was as low as the best performing millennial group is doing was actually right after the Great Recession. It was in 2012. And that's what Gen Xers were encountering. But we can see that their homeownership rate was actually considerably higher back in many of those years as well. So we know that there's headwinds for these young millennial buyers to be able to enter into homeownership. And so we really started scratching the surface into the student loan debt issue. We also knew that spending is considerably different today for every generation than it is for past generations. So we know today that younger millennials and older millennials are spending more every day on their housing, but they're also spending more on their education. In comparison, younger boomers, Gen Xers, they were spending more on transportation. They were spending more on food away from home and apparel and services, things that younger millennials and older millennials just weren't able to spend their money on today. So digging into this, we know that student loan debt now is above $1.5 trillion. Some estimates are as high as $1.7 trillion. We also know that more than 40 million Americans are holding student loan debt. But unfortunately, when we look at who is holding student loan debt, we can see that the aggregate loan balances are actually disproportionately younger borrowers. So those who have exited college may now be in grad school taking on additional loans, and they're holding the highest balances of student loan debt as an aggregate amount. Now, one of the things that I want to point out here before I jump into the new NAR results is that we often talk about student loan debt as a millennial issue, and absolutely they have higher balances. They're more likely to have student loan debt. They graduated into a very difficult time for them to obtain a job if they're an older millennial. And I will say older millennials and younger millennials probably have a much different experience. But we also know that this is an all generation issue. And I don't want that to get lost. And I know that Rachel is going to touch on some of that as well as the other speakers. But I really do want to look at just the increase in student loan debt for even the highest age groups. We actually can see since 2004 to today, it's increased nearly 2,000% as an aggregate balance. So it really is an all generation issue, and there's lots of reason behind that. And I know that she's going to dig into that as well. So I'm not going to touch too much there, but I just do want to keep that in mind as we talk about this as a millennial issue. It really is impacting so many others. All right, so let me jump into the latest results that we have here. These are based on survey results of either someone who is currently holding a loan or someone who has recently paid off their loan in the last 2 years. So maybe they paid it off during the pandemic and they got ahead by cutting spending on other items, and they were really able to tackle on their debt. This is also looking at people who are not only holding it for themselves, but they could actually be holding it for a dependent, a child, they could be holding it for a spouse. So we're looking at the all-encompassing universe of student loan debt holders here, not just focus on a particular age group. So jumping into the recent results, the first question that we had was, how is the pandemic stimulus packages, how have they helped people actually get ahead on their student loan debt? Has it helped people pay down their debt? What we found is for 38% of borrowers, they did say that yes, the pandemic stimulus packages helped them get closer. So maybe that was the zero interest on federal student loan payments, and they were able to pay down more to their monthly payment to the principal of their debt, or they were able to cut spending on other areas of their life. Some people actually moved back in with their parents and they were able to get ahead of their student loan debt that way. And some just moved to lower cost areas, something that the pandemic and remote work really helped with. And so folks were able to get ahead of their student loan debt. I have to say though, for the majority of student loan debt holders, it didn't actually help them get ahead. 54% said no, there was no impact here. It didn't help me get ahead. The other thing that is a big question today is, are borrowers aware of when they enter into college? Are they aware of the debt that they're taking on? And do they understand the future earnings? What we did find is that for some, they are aware of their current debt and what they are taking on when they enter college. That being said, and I think something that's really important in the findings is that Gen Zers were actually the most likely to understand the cost of college. And I think that's really important. So maybe the word is getting out there now for youngest borrowers. Maybe they're understanding the burden. Maybe they're seeing the articles that Brian mentioned, and they're really understanding, okay, yes, I know what I'm getting in myself into. I'm going into this with my eyes open. Now, as it comes to potential earnings, that's the good thing. We do know that 65% of borrowers are saying, yes, I at least know that I'm going to make more when I exit college than if I just had a high school diploma. The other thing that this really comes down to, though, is once you exit college, are you actually making employment choices that are from your degree? Are you in your actual place of study once you obtained that degree? Are you on a career path that this degree really helped you with? What we found, unfortunately, is that for 58% of student loan debt borrowers, they changed their employment. And they did so because they wanted to pay off their debt faster. They had to get ahead of it. They either moved career choices altogether, maybe they took on a second job, maybe they looked at a career path that was just not interesting at all to them and they really wanted to move jobs, but they couldn't. The thing that I think is really striking here, and Brian touched on this too, is the disproportionate impact. And we really do see when we look at these results that for Black and Hispanic borrowers, and even for males, just overall, regardless of race, they are more likely to actually change their career path and their employment options because of their student loan debt. The other thing that we wanted to do here is we wanted to have kind of a make-believe scenario. So if your job were to actually offer you some repayment program, would you actually take a different job? Would you change career paths? And this is, I think, a good note to employers today who are struggling to actually have full employment. 59% of borrowers are willing to actually change their employment just to have an employer to be able to pay down their debt and get ahead of it. So that's a great benefit to those borrowers out there. The next thing we wanted to know is, are borrowers, are they actually able to contribute to retirement today? And what we found is that largely, no, not necessarily. We did see that 27% are contributing what they want when they wanted, but more than a quarter are not at all contributing. And we did find a mix of people who were actually having to either step back from contributing during certain time periods, or maybe they couldn't contribute the full amount that they wanted. Some actually even had to borrow against their 401k. Something that we do see actually higher for Black successful home buyers is that some are actually borrowing against their retirement savings to be able to pay for a down payment as well. So not a great scenario for those individuals when they think about building wealth from their retirement. The next thing we wanted to know is the ability to even have an emergency savings fund. Maybe you can't contribute to your retirement, but are you able to have an emergency savings fund? Unfortunately, what we found is that for 40% of individuals, they were not able to contribute and even have $500 in emergency savings. So not a great outlook, especially with everything that life throws at us on a daily basis. So next, we get into the homeownership and we get into headship rates. So headship rates being essentially, are you able to move out of your family member's home? And I think that's a key because if you're able to jump into that rental market, that's a good indicator that maybe you can live independently, you can buy a home, you are a renter, but maybe you can put away that savings for that down payment and really jump in. So looking at the headship rates, the idea of moving out of the family member's home, I think it's really important here, two particular points on this chart. One is that we see the highest level of Gen Zers who are living at home, not necessarily a surprise as they're probably young 20s, they're graduating in the pandemic, or they're in the pandemic and they haven't graduated yet, but they're likely to be at home. That's okay, we'll take that one. Millennials, though, I think this is where we get pretty tricky. We can see the difference between millennial borrowers and Gen X borrowers, and it jumped considerably. Gen X borrowers, when they graduated from college, when they were done borrowing cash for college, they were able to move out and live independently, where we see that most millennials are not able to do that at 62%. So quite the difference there. The other difference that I think is incredibly important to point out here is the difference between Hispanic and Black borrowers versus white borrowers. And what we can see here is there's a higher share of Hispanic and Black borrowers who are not able to move out. We know that they're taking on higher amounts of student loan debt. We also know that they have lower earnings once they graduate from college. So both of those factors really contributing to their ability to live independently and for their ability to rent, even with a roommate. The next question, of course, is can they buy a home? What we found is for half of non-owners who we did survey, they said that student loan debt is delaying them from purchasing a home. It is the highest for millennials. Again, probably not surprising as they're taking on very large amounts of debt, a disproportionate amount of debt compared to other generations. And we also see that high income earners, those who are actually making six figures, they also are not able to actually purchase a home. Now, with this result, I really do want to point out that some of the past numbers we talked about already, the ability to have emergency savings or contribute to retirement and long-term savings, those were also all impacted. So it could be for those borrowers who are earning $50,000 or less, or those who are making 50 to 100. Homeownership is just so far off, they can't actually think about it right now. And so that's not even on their radar. What I will say is we asked a follow-up question here and we said, okay, pretend, again, make believe that you've paid off your student loan debt, then what would you do? The top things, long-term savings, just having that stability under you, and then it's buying a home. It's not buying a car, it's not going on vacation, it's buying a home. And so we know that these individuals really do want to get into homeownership. They're just really having a hard time getting there right now. And then lastly, we wanted to ask a follow-up question as well. What are the top reasons that delayed you from your ability to purchase a home? Why can't you? And the ability to save for a down payment. They don't think they can qualify due to their debt to income ratio. They just don't feel financially secure. All of these reasons on the list here, and it probably is more than one for many of these borrowers. So really, I think it's a very complicated situation, but it really just is the ability to pay down that debt, get their debt to income ratio in check, but then save for the down payment as well, and those closing costs and all the unexpected costs that do come up with homeownership and just life. So thank you so much. I'm excited to hear from the other speakers.
Good morning. I'm joined now by Hannah Pitts, who is with the Mortgage Bankers Association. And really throughout the housing industry, we've all been concerned about the impact of student loan debt on the ability to purchase homes. And Hannah and the MBA, we have worked closely with on this issue and others as we seek to promote more homeownership and to close homeownership gaps. So Hannah, thank you very much for joining us today.
Thank you, Brian, and thank you to NAR for the opportunity to speak on such an important issue to America's future generations of homeowners. My name is Hannah Pitts, and I am the Assistant Director of Housing Finance Policy for the Mortgage Bankers Association. MBA is well aware of the impacts of student loan debt burdens on potential home buyers, particularly for first-time home buyers. The number of potential home buyers saddled with student loan debt is increasing, and at a time when housing affordability is coming under heavy pressure due to limited supply and rapidly rising prices. As we all know, making the required payments on student loan debt can impede aspiring homeowners from gaining headway on saving for a down payment. In today's market, these borrowers are also often in a position of competing with multiple bidders and, in more cases, all cash offers. While confronting the upfront challenge of student loan debt's impact on savings activity is largely outside of a mortgage lender's purview, the mortgage industry has advocated for sensible underwriting standards regarding payment obligations on student loan debt. This includes underwriting the borrower based on the current documented payment made, even if this payment is made under a federally backed income-based repayment plan that does not fully amortize the debt. MBA has voiced concern, for example, when agencies choose to use a different calculation to serve as a stand-in figure when income-based repayment plans are being used, such as a percentage of the total outstanding debt. These estimated payments can inflate the true monthly obligation of the borrower, thereby inflating the DTI ratio. This year, FHA changed its policy, previously the most stringent of the government programs, at a 1% calculation of the outstanding debt. And they changed it to the actual documented payment if above zero. MBA was a major advocate for this change and is really pleased to see FHA borrowers with student loan debt on a better footing to benefit from the program. As policymakers continue to evaluate the effects of student loan debt on the struggles of many potential borrowers to save sufficient funds for home ownership, the need for increased down payment assistance takes on greater urgency. Stakeholders across the housing finance community have urged Congress to provide more resources to help potential first-time home buyers, particularly those in underserved communities, to afford a down payment. MBA continues to support these efforts as they can play a key role in mitigating the impact of rising student loan debt burdens, as well as potentially narrowing the racial homeownership gap. These are worthy goals and ones that should be addressed as quickly as possible. Thank you again for the opportunity to share MBA's thoughts on this important issue.
Thank you, Hannah, and it's great to have you here today to speak to this issue.
Thank you.
Well, it's certainly great to be joined by the MBA on this very important issue. Now I'd like to welcome Rachel Fishman. She's the Deputy Director for Research with the Education Policy Program at New America. And if her name sounds familiar to you, it's because she has, her work is often cited in the New York Times, the Washington Post, and NPR. So now it's my pleasure to welcome Rachel Fishman.
Sorry, everyone, and good morning. My mute button disappeared, classic. And I'm happy to be here to discuss a particular issue related to student loan debt. And one I wanted to make you all aware of, and that we just saw some great charts about presented by Jessica, is the amount and the growing amount of debt that is held by older individuals. This includes not only the debt that that individuals have incurred for their own education, but also the debt that they may have incurred for their children's education. And so one area of research I focus on in particular at New America are federal Parent Plus loans. These are the federal loans borrowed by parents of dependent students that help fill that gap where student loans, which are federal student loans, are very limited for undergraduate, and then where their grants end and where the full cost of attendance lies. So oftentimes, particularly for a four-year degree, there is a large gap between where the student aid ends and what it takes to get that student on campus. And these are really where Parent Plus loans are increasingly coming into play for families. It is important to keep in mind that these loans have minimal underwriting standards compared to private loans, and they only require an adverse credit history check. They don't really look at a parent's ability to repay the loan or any sort of debt to income ratio. So in a way, these federal loans really occupy an in-between space. As a reminder, federal student loans, subsidized and unsubsidized direct student loans, do not come with underwriting standards. The only federal loans that come with minimal underwriting requirements are Parent and Graduate Plus loans. And today I'm going to focus solely on Parent Plus loans. So the research I conducted in 2018 found that when parent loans and student loans are considered together, federal student loan policies are driving an intergenerational accumulation of debt that is burdening the neediest of families. Sometimes this debt is predatory, and often it leads to racial inequities and income disparity. So when I did this research, I used representative Department of Education data from a cohort of students in 2012, which has subsequently been updated about 4 to 5 years ago, and is about to get updated again. I repulled the data when it was last updated, and there was not really much change. So a lot of this data still stands. If anything, the data have gotten very slightly worse. So that's something to keep in mind here. I do know that the data is about 10 years old. So this first chart shows that compared to other undergraduate borrowers, plus loan borrowers have a higher expected family contribution to pay for college, meaning that they tend to have higher incomes. So for those parents who borrow plus, when they fill out the FAFSA, which is the application for federal student aid, they get a calculation is done behind the scenes, which is called an expected family contribution. And so the important thing to keep in mind here is that a zero expected family contribution means that student's family has been determined to not be able to pay for college and should get as much aid as possible to defray the cost of college. And then the higher the EFC is, the more that that family has to pay for college. Plus loan borrowers also have somewhat similar race ethnicity representation as those whose parents do not borrow plus loans. But when you disaggregate by race and income, particularly for Black families, which we've discussed during both prior presentations, equity implications begin to appear. And here you'll see that 1/3 of Black borrowers have an expected family contribution of 0, meaning that the federal government has calculated that that family should pay nothing for college, that that family should get a full ride to college. Instead, that's not happening. Their students are borrowing loans and the parents are borrowing loans. Meanwhile, 1/3 of white borrowers have fairly high expected family contributions, indicating that they have more income to pay for higher ed. And there's a whole host of reasons as to why this is happening that I explore in a paper about the wealth gap and plus loans that I'm happy to share with anyone interested. But really, a lot of it is rooted in redlining and housing and just the wealth that got erased during the Great Recession, particularly for borrowers of color and for families of color. So the result is an intergenerational debt that burdens low-income families and Black families in particular. So here you can see in teal is the average debt burden for students whose parents borrow plus, and then the gray area is the average associated plus debt. And as you can see, Black borrowers, for the most part in every category, tend to borrow more. And I say that a lot of this loan debt we don't really talk about. So when we talk about the average loan debt that somebody graduates with, we talk about the student debt, but there needs to be almost a dotted line that continues outside of that debt and takes into account the intergenerational debt burden that many families are facing to put a child through college. What's more is that PLUS loans are the only undergraduate federal loan that's been increasing in volume over the years. So it's definitely something that policymakers should keep their eyes on. These loans have serious borrower implications. They cannot easily be paid through income-driven repayment plans, and parents face harsh penalties like wage garnishment, Social Security, and tax offsets. And when you think of people who are very likely to be reliant on Social Security for retirement, it's concerning that they're taking on considerable debts as they're heading towards retirement and then could have it garnished by the federal government. And this is where I think that this debt has become predatory for some families. So I've made several policy recommendations throughout the years of how we could change this program. And my policy recommendations shift over time as there's been little changes with the program and as we're debating issues about student loan cancellation and affordability. But here are some of the top recommendations that I've made. And it's my hope that by raising awareness on this issue, policymakers can focus on solutions to address the root cause of borrowing. These are affordability issues, but also we need to consider the fraying and dismantling of America's social safety net and entrenched systemic racism. So you have to also address housing costs and food insecurity. You have to think about affordable childcare and affordable healthcare. Those are also weighing on a family's balance sheets, and college is just one other thing that also weighs on the balance sheet that we need to make more affordable. So among my recommendations, I think there needs to be ability to pay added to an ability to pay metric added to the underwriting of a PLUS loan using EFC or a similar measure. And then if a family does not pass that check, they either should get more federal grant aid in an ideal scenario, in a less ideal scenario, perhaps more direct federal student loan debt. Also, we should allow for income-driven repayment for new Parent Plus borrowers because if their income dramatically shifts after they have obtained the loan, then they should have access to a more affordable monthly payment based on their income. We should prevent institutions from listing PLUS loans in their financial aid offers. We should require entrance counseling and better disclosure. Currently, there's not any entrance counseling requirement, and there's very little disclosure surrounding PLUS loans. We need to collect better data on PLUS loans because there's hardly any. So the student loan data that exists is imperfect, and everyone will tell you we always need better data, but we just don't have very good data at all on PLUS loans. So we need to have a better handle on where the PLUS loan is a crisis for which types of families. We need to hold colleges accountable for the default rates of PLUS loans. Right now, colleges are held accountable for student loan default rates, but PLUS loans are not part of that equation. We need to allow PLUS loans to be dischargeable in bankruptcy. We need to seriously address college affordability, particularly for the four-year degree. There's a number of mechanisms here, including doubling the Pell Grant, making college tuition free in the 2- and 4-year sectors, putting a large investment into minority serving institutions. But again, we need to figure out the affordability crisis. We need to keep and strengthen accountability measures for institutions, particularly for for-profits, where a lot of abuses take place and where students really struggle to pay their loans. And we need to allow for loan cancellation. For example, if someone has been in a federally means-tested program for 3 years, the likelihood of them repaying their loans is very minimal. So we need to figure out how to get those loans off balance sheets quicker and provide relief to borrowers. And we also need to preserve and improve PSLF, which is public service loan forgiveness, which has been in the news a lot lately. Most parent borrowers do not qualify for PSLF, but that needs to change, and allowing IDR for new borrowers or income-driven repayment for new borrowers should help alleviate that problem moving forward. So thank you for letting me take the time to talk to you today, and I look forward to hearing the rest of the presentations.
Wow, thank you, Rachel. And I hope that people took a screenshot of your presentation just now, especially the policy recommendations there. So much great content there. And I've got some questions for you afterward, so I'm looking forward to that. So next we have Nikita Bailey, and Nikita is the Senior Vice President at the National Fair Housing Alliance. We have worked closely with Nikita both at the National Fair Housing Alliance and in her former role as the Executive Vice President at the Center for Responsible Lending. Nikita authored some great work on student loan debt. And I know Nikita knows just innately how this is a fair housing issue as well. So look forward to hearing from Nikita specifically on the impact of student loan debt on the Black home ownership gap, or the home ownership gap for people of color, and what solutions she may have on how we can get ahead of this. Glad to have you here today, Nikita.
Thank you, Brian. Good morning. I'm Nikita Bailey, a Senior Vice President of Public Policy at the National Fair Housing Alliance. NAFA is a national civil rights organization established in 1988 to advance housing justice. NAFA has been working for more than 30 years to eliminate all forms of housing discrimination and ensure that every community is well-resourced with opportunities and amenities people need to thrive. We also have a tech equity initiative that is a multifaceted program that is designed to eliminate bias in algorithmic-based systems used in housing and financial services systems. My remarks today will focus on how student loan debt affects borrowers and access to credit, especially in communities of color. I'll also highlight the need for targeted down payment assistance to help overcome the barrier of student loan debt, and NAFA's Keys Unlock Dreams initiative, a program designed to help overcome structural barriers, expand fair and affordable housing options, and help close the racial wealth and homeownership gaps. As we've already heard, student loan debt has a disproportionate impact on people of color. After the Great Recession, states diverted resources away from public education, forcing all students to rely more on loans as a means to fund higher education. As a result of our nation's legacy of housing discrimination and exclusionary federal homeownership policies that excluded families of color, Black and Brown families have less overall wealth than whites. Homeownership and its resulting home equity are the primary ways that most Americans built their family's wealth. In the first 35 years of the FHA insured mortgage loan program, only 2% of those loans went to families of color. Even today, the Black homeownership rate is as low as it was since discrimination was legal. And the 30-point difference in the Black-white homeownership rate is as low as it was in 1890. Because of this history, students of color are forced to borrow more with fewer family resources. They also take on more unaffordable loans, positioning them to have higher defaults. The borrowers who default have their credit and wealth building capacity significantly damaged going forward. Black students in particular typically borrow more and have a harder time paying their loans, due to a long history of structural racism and discrimination resulting in the racial wealth gap and income inequality. After 20 years in repayment, the typical Black borrower still owes 95% of the original cumulative balance. The perils of default are felt most acutely for Black borrowers, as they are particularly at risk of default and also more likely to lack access to affordable credit products even before additional damage of student loan default to their credit profiles. Latino students also borrow more and end up leaving college prior to completing their degrees under the weight of student loan debt. African American and Latino students struggle to fund their college experiences due to broad societal discrimination, and too often are preyed upon by poor quality for-profit institutions that actually fail to provide reliable educational benefits. So these students are disproportionately in a situation where they leave these predatory for-profit institutions without the quality of education that helps them to secure employment. Thus, they end up in a default position. And even before COVID-19, student loan borrowers overall struggled under the weight of more than $1.6 trillion in debt. 1 in 4 borrowers defaulted, or were in serious delinquency. And many worried about their ability to make student loan payments while covering other basic necessities. Because of decades of structural inequities and discrimination, student loans have burdened Black and Latino borrowers more than other groups. And now these very same borrowers are among those who are more disproportionately harmed by COVID-19. So we know that millions of student loan lives were actually stymied before the public crisis, and now as borrowers struggle with COVID-19 and income loss and devastated savings, they are bracing for more of a financial disaster. And then even after graduation, African-American and Latino people face substantial job discrimination as has been discussed, and earn far less than their white counterparts. African-Americans can also face more difficulty paying off debt and building savings to withstand future financial shocks because of this income gap. Given these disadvantages, these students tend to take longer to pay their loans back in comparison to their white counterparts. In fact, recent research shows that rather than helping students of color build wealth, a college education actually deepens the wealth gap due to the high costs and structural issues in our system. For example, young African Americans take on 85% more student debt than their white counterparts for their education, and that difference in indebtedness increases by almost 7% per year after leaving school. Despite these facts, for most students, especially students of color, the pursuit of higher education is not a choice. Indeed, post-secondary education is now a necessity and not a luxury. It's something that one must assume in order to succeed in today's workforce. Another factor is that a degree is not a shield from racial disparities. African-American bachelor degree graduates default at 5 times the rate of white bachelor degree graduates and are more likely to default than whites who never finished a degree. Latino bachelor's degree graduates default at twice the rate as whites, and even those who can pay are struggling. Nearly half of African-American graduates with a bachelor's degree owe more on their undergraduate student loan after 4 years than they did at graduation, in comparison to 17% of white graduates and approximately 23% of Latinos. This derails their financial and personal lives and subjects them to harsh collection practices that can keep them from achieving wealth gains promised by a college education. Meanwhile, their debts continue to grow and the unlimited interest accrual because there's no statute of limitations on student debt. The interplay between student loan payments and other life investments and responsibilities is well documented. Research from NAR shows that the usual student loan borrower delays the purchase of their first home by 7 years because of student loan debt. This has serious implications for the housing market. Moving forward, the market for new home ownership will be predominantly borrowers of color, and long-term student loan debt threatens to shrink the available pool of buyers unless we take bold action. This new generation of homeowners will be strapped in debt that will prevent them from really advancing in their personal lives. Because of this, the National Fair Housing Alliance and the Center for Responsible Lending work together to create a targeted down payment assistance program. Part of the reason why we see that student loan debt is a barrier is because it really impacts the ability of a family to really save for a down payment. So we know that lack of down payment is a major barrier to homeownership for many families of color. And we know that many Black and Brown consumers actually have sufficient income to pay a monthly mortgage. However, they lack the intergenerational wealth because of the exclusionary federal policies that I referenced before that actually prevented their families from entering into home ownership and building home equity that could be used to help cover the cost of a higher education. So we believe that a targeted down payment assistance program could be designed as a way to really open up homeownership. And when we say targeted, we mean that it should be targeted by first generation, not just necessarily first-time home buyer. And we know that if you target these resources based on data done by the Urban Institute, we could actually grow homeownership by 5 million new home buyers, and that 1.7 million of these buyers will be Black and 1.32 million will be Latino. We've advocated for the inclusion of this targeted down payment assistance, which has already passed in the House Financial Services Committee as part of Chairwoman Waters' Down Payment Toward Equity Act. This legislation has also been introduced in the Senate by Senator Warnock and his colleagues. Both pieces of legislation are calling for a real bold investment of $100 billion in targeted DPA. We know that even just $30 billion of this targeted down payment assistance can actually grow homeownership by 1 percentage point. So when we talk about that, ongoing Black-white wealth divide and homeownership gap, we could see that actually close by a percentage point. And we could actually create more than 500,000 new Black and Latino homeowners and include 88,000 Asian Pacific Islanders and Native homeowners. So this could be a positive action that could really help to bring in borrowers who are struggling under the weight of student loan debt, who have the capacity to actually pay for a mortgage, but simply cannot afford to pay and save for that down payment. Another priority is the Keys Unlock Dreams initiatives. The heart of the Keys Unlock Dreams initiative is to close the racial wealth and homeownership gaps, and student loan debt is standing in the way of that. According to the Urban Institute, there are 21 million mortgage-ready millennials who have the income and credit score to qualify for a mortgage loan today. Of that number, again, 1.7 million are Black and 4.6 million are Latino. Unfortunately, debt to income ratio continues to be one of the main reasons for mortgage denials for aspiring home buyers of color. Student loan debt is most certainly part of that equation. The National Center for Education Statistics highlight that Black college graduates owe an average of $25,000 more in student loan debt than white college graduates. That again is going back to the points that I mentioned earlier related to the lack of the ability to really build up wealth through home equity. When we talk about structural barriers that perpetuate racial inequality, education debt needs to be mentioned alongside historic discriminatory housing policies. Through the Keys Unlock Dreams initiative, NAFA is working with industry partners to develop new products to support credit access for underserved groups, create an infrastructure for small dollar loans, develop loan programs and products to promote racial equity, and explore the responsible use of alternative credit and reporting of non-traditional credit to expand equitable opportunities. And I'll just pause here to say, we are excited about the new ability to really incorporate rental payment history and mortgage loan determinations. We want to be very careful though, to make sure that that doesn't allow for the disparity in pricing. We also, through the Keys Unlock Dreams initiative, are working to create innovative pathways to homeownership that is really crucial in supporting opportunity for equitable opportunities across the nation. I'll stop there and I look forward to answering your questions.
Wow. Well, thank you, Nikita. Really appreciated that presentation. No doubt there is a lot to unpack there, and there are some questions I want to ask you when we talk afterwards. But it's unquestionable that this is an issue that's disproportionately affecting people of color, and that to grow the market, we have to figure out some solutions. So next I want to go to Ben Kaufman. Ben is the head of investigations and the senior policy advisor at the Student Borrower Protection Center. Ben has also worked at the Consumer Financial Protection Bureau and was an investment banker at JP Morgan. He's a graduate of Stanford University. He got a BA and MA there in public policy. So he probably acutely understands the intersection between public policy and expensive education. Ben, it's a great pleasure to have you here today.
Great to be here, Brian. You make me sound like someone much better than me. Thanks for having me here. Thanks for all the panelists who came before me. You guys are a tough act to follow. My name is Ben. I work at a place called the Student Borrower Protection Center. If you watch 60 Minutes, my boss was on a couple weeks ago talking about military student loan debt. So we're a national nonprofit that just does student loans. We do everything from the beginning, whole life cycle, all the effects that they have on people. And what I want to talk about, with my time is to kind of like take a broader view of what is really going on with the student debt crisis, how it affects borrowers across the economic spectrum and across their kind of economic lives, and then kind of just how we got here and what that means for the path forward. When we kind of go around and do our little shtick, people will ask us, is the student debt crisis really as bad as I've heard it is, folks will say. And we always answer that no, in fact, it's a lot worse. Student loan debt has exploded in the US in the past several decades. It's increased 552%, using this data from the New York Fed, just far outpacing any other area of consumer credit. And when you dig into how this happened, it's pretty simple. You have more people borrowing, and they're all borrowing more. I mean, the number of student loan borrowers has effectively doubled in about a decade. The average student loan borrower now has more than $30,000 student loan debt. And something my boss Seth likes to say is that we basically added, $1 trillion to $1.5 trillion of student loans with basically very little infrastructure of consumer protection. What this all means for families is that, as some of the other folks have talked about, this just takes a bigger and bigger piece of their household finances. This just becomes such an outsized part of the kind of, kitchen table conversation about what we're going to spend our money on, how we're going to allocate dollars towards our bills. And also, as you've seen this kind of unbelievable growth in student loan debt, one effect is that, as has been a big point today, a lot of the kind of mythology around the student debt crisis has just become totally untrue. So I guess folks on this in this meeting have kind of already had this illusion taken away from them. But often when we talk about student loan debt, people imagine young people, right? People imagine people right out of school. And in fact, almost 2/3 of borrowers now are above the age of 30. And we know there's data from the Consumer Financial Protection Bureau that shows that the age demographic for whom student loans are growing the fastest are seniors. That's in part because of the Parent Plus loans that Rachel was talking about. But it's not just the fact that people are taking on all this debt to try to pursue higher ed, it's that they're struggling. This is also a crisis of repayment. This is some analysis that we did on top of data from the New York Fed showing that even before COVID, right? So even after we'd had this kind of decade of pretty steady growth in the economy, right before all these interventions came in, like the payment pause, the rate of delinquency on student loans was higher, and in fact, a lot higher than the rate of delinquency on mortgages at the peak of the mortgage crisis, something that I imagine is, near to the hearts and memories of a lot of folks who are watching this right now. And just to really put a point on it, again, in 2019, it seemed that the economy was pretty strong, but you saw this consistent march of people defaulting on student loans. So for the last full federal fiscal year, for which we have complete data before all the COVID interventions happened and kind of messed with the numbers, a borrower was defaulting just on a federal direct student loan every 26 seconds. That's not even to talk about like private student loans, refi loans, other older kinds of federal student loans that aren't direct loans, like FFEL loans, so on and so forth. Now, of course, this all weighs the heaviest on the people who are already the most financially vulnerable. So these are some numbers from right here in Washington, D.C., where I am. You see that the people for whom student loan debt is the greatest burden are the people who are already in households that are subprime credits, right? The weight of student loan debt on the people for whom student loan debt is growing the most weighty are the people who are already likely to be facing the most financial strain. And as has been touched on in a lot of points today, there is a huge racial element to all of this, right? So this is some research that we did doing some case studies across cities in the US. And if you look at San Francisco, for example, and you take the neighborhoods that are most densely Black and Latino by population, and you compare them to the neighborhoods in the same city, often really close by, that are the most white by population, you find that the delinquency rate on student loans in the most densely Black and Latino neighborhoods is 7.5 times higher than in the whitest neighborhoods. So just to put that in perspective, if you go across the bay to Oakland, the city sued Wells Fargo in the wake of the financial crisis related to predatory lending activity. And what they found in that lawsuit was that the loans that Wells had targeted toward Black and Latino communities were about five times more likely to end up in foreclosure than the same loans in the majority white neighborhoods. So again, just to put a pin on all this, the kind of racially disparate outcomes that we're seeing in the student loan market right now really starkly resemble the worst instances of mortgage redlining from the last crisis. This all plays out in really harsh ways throughout the entire economy. And I notice how much time I'm taking here. Here we have Chairman Powell at the Fed talking about how student loans are holding back not just individual borrowers, but really growth across the board. And that's because, and I'll skip through these kind of quickly, you see people with student loan debt generating less wealth. They struggle more in the labor market. They end up earning less than people with the same level of education who don't have to take on loans. And they take a huge hit to their credit, right? And in fact, a kind of perverse incentive is that if you are someone who is financially strained and you access some of the protections that are available to federal student loan borrowers like income-driven repayment, you might find that your balance grows and that makes you appear less creditworthy, even though your monthly payments are actually more manageable. This all just ends up compounding the kind of racial disparities we've been talking about. And I know Nikita mentioned the statistic, but right after, this is research from some folks at Brandeis showing that 20 years into repayment, the typical Black borrower still owes 95% of their original balance, while the typical white borrower has paid down almost 95% of their original balance. And what's really driving that is the instances of people not making any progress on their loans at all. So this is additional research from the Jane Family Institute showing that 3 out of every 4 loans, student loans, that's owed in a majority Black neighborhood, it now has a balance that's greater than the balance that was originally taken out. So that means not just that the person is not making progress, but in fact, they've accrued interest, so now they owe more than they originally did. We're here to talk about housing, so of course we come back to housing. This is Jamie Dimon from JP Morgan, my former employer, talking about how a $1,000 increase in student debt reduces subsequent home ownership rates by 1.8%. And you know, that sounds small, right? But on the scale of an economy, it becomes massive. And it's because of what we were talking about before, where people who take on student loan debt face a massive credit hit. Folks have estimated that just by 2014, which I guess now is almost a decade ago, there would have been 400,000 more homeowners if not for student loan debt. And additional research we've done shows that when people are able to get a mortgage, they end up paying more for it if they have student loans. And that all just stands to reason, right? A mortgage is generally a large dollar loan. Even a small change in interest rate can have a big effect on how much you pay over the life of the loan. So we did some comparison with some data from, I believe it was Experian, looking at how someone with a relatively small balance of student loans would end up paying on a mortgage versus someone with a relatively large balance of student loans based on prevailing rates in the market. And we found that this person with more student loan debt would end up paying about $25,000 more on a mortgage than the same person with less student loan debt. And the effect of this is just getting worse. This is additional research from the Dallas Fed showing that in 2008, there was no statistical difference in credit scores between people with student loan debt and people who didn't have student loan debt, but that by 2013, there was a really sizable gap, and this has probably only grown. I'm really short on time and I don't want to hold everyone up, so I'll just kind of skip to the end where, you know, so much of this is all just policy choices, right? And it's not just because these student loans are federal, but because, you know, consumer credit markets in general are a thing that we kind of build as a society. And every single day in Washington and over the past several decades, people at every level of government, from local to state to federal governments, have been making the decisions here, decisions which, had folks like all of you on the call been at the table, you might have been able to point out the kind of obvious adverse effects that building this debt-based higher ed system and catalyzing the student debt crisis would have on home ownership, would have on individuals, would have across the economy. So if I can leave you with anything, it is the imperative for you to claim and boldly grab your seat at the table so that your voices can be heard, because, you know, again, had they been heard at the outset, I don't think that we would have seen the decisions that drove the kind of consequences that we're seeing today. So thanks on that happy note.
All right. Well, thank you, Ben. And we certainly will get to some happy notes as we talk about solutions. And that's really the first question I want to ask all of you now that you're all back here. What are the low-hanging fruit here? So obviously, there are many, many recommendations. Rachel had a great slide with, I think I counted like 11 recommendations. But if in this politically divisive environment, you thought there was something we could get through, what would be the low-hanging fruit and the easiest first step we could take politically? I'll throw that out to everyone, anyone who wants to jump in.
I think the targeted down payment assistance is something that we should definitely be able to achieve. When we talk about targeting this down payment assistance by first generation, we know that we have the opportunity to actually grow the economy as a result of this investment. So this is something that would actually not only really help open up opportunity for Black, Latinos, and other families of color to enter into homeownership, we have the ability to really generate thousands of jobs and jurisdictions all over the country and billions of dollars in local revenues. Studies have shown that if you just address the discrimination in the marketplace targeted at African Americans overall, we could actually see the economy grow by $1 trillion. And that is discrimination, including housing discrimination. We know that one of the major barriers into entry is just the ability to save for a down payment because of that history of housing discrimination and its inability to build intergenerational wealth. So this is a racial equity and justice solution, but it's also a good for the economy solution. 7 out of 10, all future mortgage holders are going to be families of color. Older homeowners need these young families of color to access a mortgage loan so that they can actually sell their home and have a really safe retirement. So we're hopeful that the down payment assistance will be incorporated in the reconciliation package at a minimum of $30 billion.
All right, well, that's fascinating, Nikita, and I see with that suggestion, you sort of leap to the prize, right? Get people into housing, and housing can be a wealth generator, and you sort of bypass a lot of the other issues like debt to income ratios that are caused by student loan debt, et cetera. People may still have that debt, but the housing may help abate some of it.
And indeed, Brian, we know that even if you invest $30 billion in targeted DPA, you are likely to generate and leverage on the economy $150 billion. That's based on some calculations of NAR's data that shows how much the cost of an average home will actually generate for the economy overall.
Anyone else want to offer what they see as a quick hit on this issue? If you had one shot at the elephant, what might it be? All right, well, you can think about it. Let me ask a question to Rachel. You mentioned the cost of education. It certainly does seem like the cost of a 4-year education has exploded in recent years. When I think about what it will cost when my 3 children go to school, I've resolved that I am not going to buy lunch today. I will save that money. Can you explain what's going on? Because I imagine there are a lot of people viewing this who have a difficult time relating, unless they're actually paying this right now, difficult time relating to the cost of education today.
Yeah, so for years now, and I believe it was Nikita who talked a little bit about this, and it happened particularly during the Great Recession, but there's been an overall disinvestment in public higher education. And it's important to keep in mind that 80% of students attend public higher education institutions. And so because of this disinvestment, the price of tuition has grown over the years. And every time there's a recession, one of the budgets that is easiest source for a state to cut tends to be the higher education budget, because there are mandatory expenses that and less revenues coming in. And so a lot of times states have no choice but to then cut higher education. And then sometimes they do have a choice and they still cut higher education because they're trying to balance different priorities depending what's going on in the state. And so this is why we've seen such a dramatic increase over the years in tuition and fees. Another thing that we have to keep in mind is that there's more to the cost of college. In fact, a lot more to the cost of college than just tuition and fees. So what goes into the total cost of attendance for college, of which colleges use to base their financial aid budgets, is not only the tuition and fees, but it's also room and board, which can be room and board on campus or off campus. It's also, healthcare costs and other personal expenses and books and supplies. And all of those costs as part of the cost of attendance also have been increasing. I mean, I know everyone here is familiar with how expensive housing and food have gotten. And we've seen as a result for college students that enormous amounts of college students are facing housing and food insecurity. It's also important to keep in mind one statistics that I like to put out there that a lot of people don't realize in terms of how non-traditional in people's minds the current student population is that 1 in 4 actually cares for a dependent. So 1 in 4 is a parent or a caregiver of some kind. And so we have the associated childcare costs there, of which if you're caring for a child, that's part of your cost of attendance to attend school. And as a mother of 2 young children, the thing that actually held me back the most from purchasing a house, I recently purchased a house a year ago, so I was finally able to do that. But the thing that held me back the most was the astronomical childcare costs, which were more than my mortgage payment. And so it was like having a double mortgage payment. And oh yeah, also on the side, I had a student loan payment. So again, when I talked before about the fraying of the social safety net and how we need to support people holistically, there's a lot of things happening in the equation, of which, yes, student loans are a drag, but it's important to think about how we can address some of these other really large issues like childcare, which we're trying to address through reconciliation, that could help alleviate for borrowers what's happening.
Wow, wonderful points. And you're absolutely right. All of the costs beyond the actual education, many people struggle with if they are not even going to school. So the idea of student loan debt on top of that, or the cost of education on top of that, certainly compounds issues. Dare I ask, are there solutions from Europe or anywhere else to look at, either in terms of how we pay for education or how we educate?
I don't know if we have to go all the way to Europe, Brian. I think we can look at American policies, right? Like for a long time as a nation, higher education was a public good. It was something that, we really believed in. Most of our states have land grant institutions. And, increasingly since the Great Recession, we've really moved away from that commitment. And one has to really note that this move away has also happened, as the browning of America is occurring. Public education is something that has really helped been a bedrock of, opportunity across our country. And we as a nation need to make that choice to return to that commitment. As I shared earlier, most people need, a higher, post-secondary degree in order to enter into the labor force. If we're going to be a competitive nation, we need to make sure that students have access to higher education. And I won't, take Ben's point on this. I'll just tee it up for him a little bit. There's a real reason why advocates are demanding for the cancellation of student loan debt, because it's a drag on our economy.
If I could actually just, jump off that, like, I think that so much of the conversation around student loan debt is framed around unintended consequences, right? There's actually a book about the student loan system called Unintended Consequences. And I think that that's wrong. I think that the framing should be that when it comes to having a debt-based higher ed system, we've tried everything, right? Like we before the Sputnik loans, which was the first federal student loans, we had a system where like you could take out a private loan or you just probably weren't going to go to college. And that was bad, right? And like people didn't go to college who probably should have. We tried having kind of like a private public partnership where like the federal government or like banks made the loans and the government guaranteed them. And, you know, eventually everyone just hated that system because like the banks still didn't like lending to students and the government had to increase the level of subsidization to the point where like you had all of the upside going to the private sector and all the downside going to government. And effectively the banks were just middlemen. And now we have a system of direct lending. And, you know, we still just see this massive march of student loan debt and all of its ripple effects. So like, it's, you know, we always talk about individual choices and unintended secondary effects of the existing structure. But the thing that we don't talk about is just the one thing that we haven't tried, which is what Nikita was talking about, which is just like funding higher ed, right? And like making it possible for people to pursue a better life without having to mortgage their future. Because like, you know, in a nation where tuition is set privately by colleges and where there probably will never be any like meaningful political consensus around a way to like limit their ability to do that, they're just gonna keep raising the price, right? And people are going to borrow because it is like the way to have a better life. And I mean, I don't know how we can blame people for that. So stop ranting.
Yeah, Nikita, can you say a little bit more? Oh, I'm sorry, Jessica, go ahead, jump in.
I will just say on the other countries, when we look at other countries in Europe, I personally did my doctorate in the UK and I just finished a couple of years ago. And I did that on purpose because even when I added in the flights of having to go a few times a year, it was a fraction, a sad, hilarious fraction of the cost to do a 3-year doctorate degree. Even when it came to needing textbooks that would have cost me $500 within the US, my professor was happy to send me a link of here's the textbook. You don't need to buy it. Here you go. That's an American author. And there's no reason why, when we think about just the cost of individual things like that, that we have to pay them. And they were happy, of course, because it's the UK. And if we're watching Ted Lasso, to provide me healthcare as well when I was there, or any access to services that I would have had to be, I think, nickel and dime for, which Rachel talked about. It's not just the tuition, it's everything else that's involved that adds up very, very quickly.
Thank you, Jessica. You have a value-added tax there, but I guess even with that, it was still cheaper, huh? Nikita, you mentioned the impact of some exploitative for-profit colleges. Can you describe the scope of that problem and, you know, what would be your top recommendations on how we address that?
Sure, it's a huge problem. People are attending these institutions with the promise that they can create a better life for themselves. Oftentimes, many of these institutions don't even have the proper curriculums to educate the students. And we actually see those institutions spending far more money on actual marketing of the institution as opposed to the quality of the education offered to the student. So we've seen in some instances, some of those schools close. For those students, that student loan debt should be canceled. Those students, you know, were brought into these institutions with this promise of higher educational outcomes, and they've not received those. So those students continue to work to make sure that debt is canceled. In other institutions, we need to see those institutions have to spend more resources on actually creating quality educational programs for the students that attend them. And if those institutions don't offer that, then one has to question why they have access to some of these federal loan programs. And I think Ben would also add a good point or two on this.
Yeah, I mean, like these, it's not obvious to me or to, I don't know anybody why it simply is the case that for-profit colleges tend to be predatory and bad and to take advantage of people, but it is just like an empirical fact that they generally do, right? And that in a kind of unique way and in a way that belies the kind of things that they will assert as defense, like that they are reaching underprivileged populations who, you know, if you see the same people go through other institutions like community colleges, you just see better outcomes. There has also just been huge resistance at the federal level to conducting meaningful oversight, right? So like, it's funny when you talk about this casually with people, they might say something like, you'd think if a school was producing a bunch of graduates who can't find jobs, they would lose their federal funding, right? And in fact, you had this thing called the gainful employment rule, right, under the Obama administration. And it wasn't perfect, but like, it kind of was schematically that kind of thing. And, you know, Betsy DeVos got rid of it. And I mean, we're hopeful that like the new administration, which is still kind of staffing up. So like the new director of the Consumer Financial Protection Bureau was sworn in yesterday. And we're hopeful that there'll be increased oversight and that there'll be more of a crackdown. But we still have to see it. There's a negotiated rulemaking process going on right now with the Department of Education to try to like reset the rules around a lot of aspects of higher ed. And there's a lot of opportunity, but we've got to, as I was saying, like we need people to kind of be really vocal about the kind of changes that are needed, because the other side has a lot of people they can pay to be vocal. So.
Hey, Ben, on student loan debt cancellation, you sometimes hear people say that it's going to benefit the most wealthy. Can you unpack that claim and respond to it?
Yeah, I mean, look, like, I think, so a couple points. First, like, it depends what you do, right? So, like, do you cancel $10,000? You cancel all of it? You cancel $50,000? I think it's also just like most of those claims are kind of constructed kind of strangely in my mind. So, like, if you were to cancel, say, like $50,000, right? Like, it is true that the people with the largest balances tend to have graduate degrees, right? But the people for whom the effect of the benefit will be the largest are the people who are least likely to pay, who are like already the most destitute, for whom the choice was either like college with debt or no college, right? I think like it's also kind of like a strange kind of way to view policy making, right? Like I guarantee you that nobody who would benefit from student debt cancellation would be bothered by the fact that someone wealthier than them might also benefit, right? And we never apply the logic conversely, right? So yeah, like if you think about like most of the kind of like hard analysis, we'll just kind of look at like levels of prevailing student loan debt and say like, look, the grad degrees have the most debt. Certainly this offers them the best benefit, especially if you do blanket loan forgiveness, but in fact, like they're going to pay those loans off usually. It's kind of an annoyance to them mostly, or they might have to delay home ownership, but those are people who probably will ultimately buy a home. But in terms of the actual realized benefit, it is far greater for low-income people, for people with less generational wealth, for people of color, so on and so forth, people who tend to for-profits and are likely to end up defaulting. And also, like, you know, when we talk about cancellation, and so back to your first question about like low-hanging fruit, there's a lot of cancellation stuff that's already law that just hasn't been really like followed through on. And like one example, which, you know, there's progress on now is public service loan forgiveness. You might have heard about last week. But there's a ton of work to do around like disability discharge, around income-driven repayment. You're supposed to get your loans forgiven if you're in repayment on income-driven repayment for 20 to 25 years. There is, you know, borrower defense to repayment. When you get defrauded by a school, you're supposed to have your loans forgiven. There's been huge issues around that. You know, just this like nuts and bolts stuff where people are supposed to already be having their rights asserted and aren't. There's just a lot of stuff to get done there.
So with debt cancellation, you wouldn't propose any kind of means testing or, you know, test the ability to repay?
I mean, you know, at the end of the day, like we know what means testing does, right? Like we've been staring at it for like 30 years. The tendency of mean testing is not to cut out undeserving people, but rather to cut out people who are deserving, but who are very busy and don't have the resources to fill out paperwork all day, right? I mean, you see this with like, we just did a paper about hurdles to income-driven repayment, which is another federal student loan protection, and comparing it to the Home Adjustment Mortgage Program, right? To HAMP from the last financial crisis. And there's this whole body of research just showing that, like, you know, when you make the qualifications really high, you don't end up excluding a lot of people who don't need the protection. You end up excluding the people who need it most.
And Brian, if I may jump in, this is a very important racial justice issue. We know that because of our country's history of, exclusionary federal housing policies, some families were set up for success. They were able to get access to homeownership and its wealth building benefits. And in many situations, private developers themselves actually help to perpetuate this discrimination. When we look at whole communities like, communities like Levittown, New York, like let's use that as an example. Developers benefited from discriminatory policies that really prevented Black families from actually purchasing a home. Those homes in Levittown today are selling for more than $400,000 and $500,000. So that wealth gap is something that families of color just have yet to have corrected. And even with the Federal Fair Housing Act of 1968 becoming law, we've never corrected for that difference, right? Like we said that from this point forward, you cannot discriminate. Discrimination is illegal, but we never corrected the hardship and the harm that families of color suffered from not getting access to those very affordably priced loans, quite frankly. So this lack of homeownership and the ability to build wealth is really a critical barrier in higher education and in student loan debt issues. And this cancellation would really be a major factor for many Black students who we've already spoken about, who have seen their debt actually grow exponentially. So this is a core racial justice issue, and organizations like the Leadership Conference on Civil Rights and Wade Henderson have really been out front calling for cancellation of student loan debt. The NAACP has called for the cancellation of student loan debt because at some point we've got to correct for previous discrimination. We can't just wish it away. We actually have to give people a level playing field so that they can have opportunity to really advance themselves.
One more question on student loan debt cancellation. What does that mean for people sort of in the pipeline, folks in school incurring debt right now? Is there a time window, time horizon on this? How do you see this working? Are they out of luck? All right, well.
I don't have a crystal ball. I doubt Ben probably has more of a crystal ball than I do, but also his crystal ball is probably a bit murky.
It's cloudy here in Washington.
It's cloudy. It has been cloudy for a long time in Washington lately. So I don't know what's going on, but I will say, we're expecting some sort of memo from the Department of Education that's going to weigh in on whether or not President Biden can cancel debt. And there's, people on both sides saying, yes, he can, no, he can't, but that memo is really important. And we haven't seen it yet. But regardless of where we stand on student loan debt and what comes to pass, borrowing is the symptom of a cost degree on a cost disease on many levels. Like I said, not only tuition, but also all of these other factors that show the fraying of the social safety net. And so you hit that button maybe to forgive student loan debt or cancel student loan debt, which will provide relief for millions upon millions of borrowers. But then I am deeply concerned of what that clock is going to start ticking the next day of anyone who enrolls the next day, right? And what comes after. And so again, accountability of institutions is going to be really important moving forward. And affordability is going to be really important moving forward. And we're trying to figure out how to fund some of that in the Reconciliation Act, perhaps 2 years of free college for community colleges and more of an investment in minority serving institutions and historically Black colleges and universities. But unfortunately, we also see that reconciliation top line number is coming down, down, down. And what ends up on the chopping block, like I talked about state budgets, is often higher education things too, because there's just so many competing priorities. When you have to weigh something like childcare next to subsidized childcare next to subsidized higher education, you know what, myself, as a higher ed person, I'm going to choose childcare because we have a serious childcare problem in this nation. And everybody starts out a child and needs access to childcare that is subsidized and affordable. And so again, addressing the affordability is going to be a really critical next step that we have to be paying attention to.
And of course, housing gets boiled down in that package too. Go ahead, Nikita.
Rachel is absolutely right that we have to think about affordability, but I think the reconciliation provides us a once in a generation opportunity to go bold. And we all need to beg the question, why do we have to come down, down, down? We've already really made a substantial commitment to discussing racial equity and putting it at the forefront of our discussions. Here's our chance to really have the political courage to do the big, bold things. The people that elected this administration want change. That's part of the change that they're demanding. So, I think she's right that, affordability is of concern, but I think we don't have to accept that the figure has to come down. I think we should stand firm and say now is the moment to deliver into the communities the very things that they elected the leadership to provide.
I totally agree, but I know that the political reality on the ground looks different. But if I had $10 trillion, I'd be spending that on all of these issues. And I think, yeah, the politics of it all holds our hands in ways that I wish it frankly didn't. And I'm with you that I'm going to keep pushing for that overall top line number and all of these changes because they're all critically important. And I hope that it all shakes out in a really bold way. That's my hope. I start losing that hope as time goes on, but I still hold it there that these important things will be included in the reconciliation as time goes on.
Holding out for a sunnier day in Washington. Jessica, you touched on this, but maybe you can put a finer point on it. There are critics who say a lot of what we're seeing today is also cultural, that young people want the latest iPhone, they want to go to brunch, that it's lifestyle. What can you say succinctly on that point?
Succinctly, it's bogus. We just don't see it in the data. So we do see that young adults today, they're spending more on housing, they're spending more on schooling than past generations at the same age. We know from other survey work that if people are not homeowners today, they want to enter home ownership, they want to invest in their future, they want long-term savings, they want a financial safety net, whether that's through home ownership or just having that $500 in emergency savings that they don't currently have. That's what they want to do if that debt was gone. And we know that there's repercussions because even when individuals enter home ownership and they're saddled with student loan debt, they'll make every sacrifice to get there. And maybe that's working 2 jobs for a period of time or cutting spending on these non-essential items. So it's not the hottest iPhone. They're willing to take the old one, work with a broken screen and really just plunge forward to really have these long-term savings through wealth gains of homeownership. We know that for successful home buyers, they're making a 19% price discount if they have the identical income to someone else. And if we think about this housing market right now, that's just completely ridiculous to try and find a home that's discounted that severely in this housing market.
Thank you, Jessica. Well, we have time for a final word from everyone and maybe only a word. So just very briefly, any last points from anyone?
I guess I'll go first since I was just talking. I would just encourage everyone to check out the full report that we did have on the impact of student loan debt. I scraped the surface, but really it's like a 60-page report. So I would encourage everyone to check out the full report in the executive summary if you don't have time to read it.
Yeah, I've gotten requests for that. Where can they find it?
It's on nar.realtor. It's in the research section in student loan debt, and you should be able to find it there.
Thank you, Jessica. Final word from anyone else? All right. Well, I want to thank everyone, Jessica, Rachel, Nikita, Ben. Thank you for this illuminating discussion on student loan debt. There's so much more we can go into here, but you've laid out some great recommendations. We have lots of policymakers, thought leaders here on the call today. So I hope folks will take away this valuable information and start whittling away at this problem. So I want to thank you all and wish everyone a pleasant day.